correction that will occur, and this has been going on like this for centuries, has always been massive rupture, massive corrections. So this is a fear, right? That indeed we create our own virtual world, metaverse, right? We are in the spirit of creating our virtual worlds, disconnected from the laws of physics, the laws of supply demand, of really, the stock flow consistent processes in economics, which can work for a while. It's an illusion of the perpetual money machine, but then the laws of physics come back with a fury, with anger, and then it's very, very painful. So yeah, what do we prefer? To live in this illusionary world, and then there will be maybe World War III, maybe a very, very big problems, maybe in 10 years, or are we ready to bite the pill, right? Bite the solution, which will be painful, but spread over time? I fear the first one will be what will happen.
On this episode of the What the Finance podcast, I have the pleasure of welcoming on Didier Sornette, who's Professor Emeritus of ETH Zurich, as well as a professor in Shenzhen in China at a university. He's also a French researcher really studying complex systems and risk management, looking at financial crises and other crises as well. So Didier, thanks so much for coming on the podcast today.
It's a pleasure.
And I really look forward to talking with you, because you've been researching a lot about, I guess, how can we predict crises? It's something that people think is impossible. So I guess from your perspective, is it possible to predict crises, I guess specifically financial crises?
Yeah, so what I'm going to do is to speak as a scientist, so which means that I'm not going to claim any truth, but be prudent in the sense that I am going to state hypotheses, which I, let's say, support with a lot of evidence. But there's always, the criticism that is possible. Okay, so my hypothesis is indeed that most, if not all, crises of catastrophes do not come out of the blue, but proceed through a significant, long, lengthy preparation process. So that if you, it's like a maturation towards an instability, towards, in a jargon term, towards a bifurcation. Actually, a catastrophe in a mathematical sense of catastrophe theory, or also a tipping point. That's another way to name it, right? Or phase transition, as we would say in physics. These do not come like a surprise for those who are prepared to look at the correct, let's say, metrics and diagnostic points. If you, of course, close your eyes, like, the famous three monkeys, and your ears and your mouth, it will be a surprise. I would say that in that sense, I am totally opposite to Nassim Taleb with the black swan. And in this way, I have actually coined the hypothesis of the Dragon King. The Dragon King is supposed to put on fire the black swan in the following sense. The Dragon King refers to two concepts. A king is an animal or an entity which is beyond the normal citizen. For example, you have the king effect in wealth distribution, which correspond to the fact that there is an entity which owns much more than the distribution of the rest of the citizens. The dragon term refers to the fact that this animal is endowed with different properties, right? And indeed, the point we have, and I have documented in many instances empirically with rigorous statistical tests, and we develop also theories based on understood mechanism, that most of crises of importance are of this Dragon King nature, meaning they are special, they are outliers in the statistical sense. They look very different in their size, in their consequences, but also in their underlying mechanism that lead to their occurrences. So if you are with me in this concept, you realize that the corollary of this concept is that they are telling signs. So weak signals, as we call them, or specific. So I have, in my research, documented maybe a dozen of different diagnostic, which are not all present, that we can look at and continuously monitor in order to see a crisis coming. And this applies to many different varied systems, from epileptic seizures, quakes of the brain, to, of course, earthquakes, catastrophic rupture in the Earth's crust, to obviously development of bubbles and their birth in the form of crashes, to maybe epidemics, also to political crisis, to health crisis, in addition to just the epileptic seizures. So, and I can go on. There are many examples.
Okay, it's really interesting. So I guess the challenge is trying to find those preluding indicators to be aware of for those different examples that you've provided.
Yes, exactly. And so in order to be guided towards this goal, I often refer to, so I apologize if I use a jargon, a bit of mathematics. There is a so-called reduction theorem, which is one of the most beautiful and more powerful theorem in mathematics, which is the following. I would say it in a layman term. So essentially, any complex system, we are ourselves a complex system. Complex system means essentially that a system is made of many elements, which are relatively simple, each of them, but are constantly interacting, and their interplay leads to the emergence of superior or higher levels of organization. Like, for example, standard example, neurons. You have 85 to 100 billion neurons. Each of them is relatively simple, but the total gives, what we're doing: speaking, thought, consciousness, and so on. Okay, so the reduction theorem says that in a complex system, most of the time, the system is not predictable. It's like you are flying a plane as a pilot in the fog. You see nothing. It's unpredictable. And the beauty of it is that when you approach a critical point, a tipping point, a bifurcation, this transition, the Dragon King, then it's like getting out of the fog and you are in clear sky and you see the mountain you are going to crash against. So this is actually, the layman version of a rigorous theorem saying that when you approach to such a catastrophe, there's a reduction of dimensionality for billions of variables to only a few. And there's only a few, like 16 normal forms, so 16 equations that describe all possibilities, that guide you on what you should look at. So science and mathematics and complex system science has advanced a lot. And I am always a bit sad to see that, about the gap between this understanding and the defense of decision makers, managers and so on, who, like Ponce Pilate, wash their hand and say, we did not know, we could not say anything, and it's not my responsibility. And one part of my research has been trying to demonstrate that these guys have a huge responsibility, but unfortunately, there is a conflict of interest. It's so easy to say, we did not see it. It's a wrath of God, and so on. Like, many crises, like 2008 crisis, which was, led to the Great Depression, fantastic pain for millions, hundreds of millions of people around the world, and so on. It's so easy to say, well, it's not my fault, it's not the policy. We could not, nobody could see it. It's wrong. A few pundits, a few persons were crying about or were shooting about the sign, the tail sign. There were obvious evidence. I even myself actually wrote a letter to the then federal chairman Greenspan in 2005. I was a professor at UCLA, telling him that we had technology showing sign of the non-sustainability of the real estate market in the US, which, as you know, was the framework on which all the collateral debt obligation, all the toxic trenches were built, and which, when the real estate price start to plateau and then to go down, led to the cascade of what we know happened. But no, it's so much easier to say we don't know, and then I don't have any responsibility. So I think this is wrong, and indeed knowledge should give rise to responsibility, and people hide behind this veil of ignorance, which science now should demonstrate is not acceptable anymore.
Yeah, it's fascinating to see to hear. So if we go to 2008, and you said you were sort of seeing these signs that there was risk in the market, specifically the housing market. So I don't know if you can go, I know it was quite long ago, but if you can go more into, I guess, what you were seeing then, and then maybe after that we can go into recent times.
Yeah. Okay, so the main, I would say, concept that is underlying all this is a concept called positive feedback. or also known in finance as pro-cyclicality. Positive feedback is obviously the opposite of negative feedback. Let me give an example. Negative feedback, you have a population of rabbits eating grass in a valley. As the population of rabbits grows, right, the population grows and eats more grass, the food start to be missing, and then there's a negative feedback of more population, of course, decimate the food, which itself give rise to a decay and a collapse of the population. So there is a negative feedback from the population on the food and the food on the population. And this is stabilizing, right? Eventually, the population will not continue to grow, it will stabilize. Positive feedback is the larger the population of rabbits, somehow, the larger the food available, the larger the population of rabbits and so on. So it's continue to grow. So for rabbits, it's not possible. But by the way, as a clear, documented empirical evidence, this example or this parable of the rabbits applies to humans. You may remember, and so I think it's a very nice illustration of this concept of positive feedback, that Malthus at the beginning of the 19th century famously called for a huge problem of a danger of a population collapse because the population was growing exponentially, he said, while he claimed that the food availability was growing only linearly. So we would come to this problem of the rabbits and they would, okay. When you look at the data, you find actually positive feedback in the human population. What does it mean? The more people there are, the more innovative we are, the more we invent, the more we control different domains, special regions, and the more we also develop fertilizer and so on and so on. So what you see as a consequence is that the growth of human population from the Middle Age to the peak of the growth rate was in 1960s, 64, has been super exponential. And I use this term because I'm going to use it later on to explain the real estate and the financial market. So super exponential means faster than exponential. So a little bit of course, a quick crash course on what is an exponential. When you invest in a bank or in finance, okay, let's say 100 of some unit, 100,000 pounds or whatever. And suppose you have 10% interest rates, right? 10% growth rate also. The next year you'll get 110, okay? Now the interest adds to, it's like a population adds to the initial. The following year will not be 120, it will be 110 plus 10% of 110, which is 11, so it will be 121. And then year after year, this initial linear growth is going to accelerate because, of course, a constant growth rate corresponds to an exponential growth, right? Explosive exponential growth. Now, super exponential means the growth rate grows itself. So the first year, so for example, and this is answering your question now, what was one of the clearest diagnostic of the non-sustainability of the real estate price dynamics was the fact that the price was super exponentially growing, meaning for, let's say, starting in 2003, maybe the growth rate for that year of the case Shiller index was 5%. Then, so exponential growth, that's 5% growth rate. So I insist for your auditor, a constant growth rate or constant interest rate is exponential growth. When the growth rate or the interest rate increases itself, it's super exponential. Okay, next year you had 10%, following year 20%, etc. Right? And so this is unsustainable. And when you actually solve mathematically this dynamics, you find again a mathematical term is called a finite time singularity. I like this term very much. Finite time singularity means what it means. It means that in finite time you have a singularity. It means it's like a black hole. Singularity. You cannot go beyond this time. You have to cross like a black hole boundary and you go to another regime. Doesn't mean necessarily a collapse of the universe or anything like this. It just means that the growth is unsustainable and has to transit to another regime. Voila. So the main concept is positive feedback. Positive feedback gives rise to super exponential growth. Super exponential growth gives rise to non-sustainability and to the they say, diagnostic of an endpoint. That's how we predict time. There's a critical time, TC, at which the regime you are living in is going to break and transition to something else. Doesn't mean necessarily the end of the world. It just means the condition for the dynamics have developed and matured so much that it's not sustainable, and there is a change of regime. And that's what we were saying in 2005, very clearly, very clearly. I remember we made a study in 2003, and we asked ourselves, do we see a problem in the real estate of US? And our conclusion at that time, no, not yet. We were doing the same thing for the UK. You're based in the UK, right? So, and we said yes, in the UK, very clear sign of a bubble, no sustainability, and actually it happened. Actually, there was two significant hiccups in the UK. The US took longer, and it's only in June 2005 when we revisited the data that we saw very clear signature, and we actually published a paper in June 2005, giving a timeline, a prediction that mid-2006 would be the time of the peak of the real estate market in the US, which happened. And then, of course, it took another year for the crisis to develop, with all the activity of the regulator, the decision maker, and so on, to try to stabilize the system. But that's it.
Yeah, no, it's fascinating to hear. So I guess if we look what happened in 2008 and what's come from that, especially the financial world, beforehand there was the Greenspan put, there was this thought that the Fed will go in and save markets, and now we've sort of had the other tools that they have QE, they have this new tool where they can buy bonds at par. So, and it's something that we were talking about before, where you're saying this zero risk game that a lot of people try to play. They try to do whatever they can to prevent all risk. So do you feel like maybe what the Fed's done and other people have done has been to try and reduce that volatility and the risk of these collapses as much as possible? And do you think that's a good thing?
Yeah, that's no, it's not a good thing. It's a bad thing. So this is related to what we were discussing together before this interview, which is the zero risk society. So the illusion that actually, there is a term for this that you probably have, many auditors have also read. This is called the great moderation. I don't know if you have heard about it. So this is a term, I think that Professor Lucas, a Nobel Prize winner, used it, and then Bernanke, the Federal Reserve Chairman Bernanke, who succeeded to Greenspan, and many others and also Greenspan were congratulating themselves by actually characterizing the 25 years. So these are discourse and conferences and interview that they gave a few years before the 2008 crisis. And at the time, it's really like, flying blind toward the mountain, right? So they were essentially congratulating themselves, saying, yeah, the 25 years, or I quote approximately, has been unheard of. These are the best 25 years in the US ever. We have seen, and also I looked at it also, but it's true, incredible low volatility in the growth of GDP, predictable. We mastered inflation, which became predictable and also with low volatility. Unemployment also has been mastered, and in the few years before the crisis, it was low with low volatility, again, very predictable. And also in finance, the financial market was pricing extremely low risk with very low implied volatility. So all indicators that, economists, decision maker, federal chairman, all these guys, Treasury Secretary are looking at, we're telling them everything is for the best, in the best of the world. For me, I was looking at another toolbox of indicators, like these super exponential behaviors and other things, and we are seeing exactly the opposite. So we could say it was a calm before the tempest, right, before the storm. And one conclusion is one should be very careful at the metrics one looks at in order to make conclusion, right? It's like, you feel a bit bad, you go to the physician, you go to the hospital, and they don't actually look at the right variable. And they say, no, you're in perfect health. And then actually there is a hidden cancer that is eating you from the inside. That's exactly the analogy that I have in my mind to refer to the pre-2008 crisis. So, and of course, during the development of the crisis, you had this QE1 quantitative easing one. QE2, QE3, QE twist, QE infinity, all this stuff. And you could see the financial market rebounding each time there's a QE, and then it exhausts itself, and the next QE, and so on, has led indeed to the conclusion that financial markets are not functioning anymore according to correct supply-demand processes. They are in the hand of, the Greenspan put, we could say the Federal Reserve put now, since 2008. So which leads to massive misallocation of resources. The zero interest rate or negative interest rate is okay, let's say, as an extraordinary measure short term, but conserved, kept for years, has led to indeed the risk-taking and the idea that money was free, right? You can borrow, many people, including myself, have benefited from this. For example, in my case, I have a 15-year loan, fixed interest, 0.5%. It's inimagible, right? It's free money. And when you have free money, of course, you have debts that is ballooning on the tune of $2 trillion of debts per year for the US right now, right? And which now is a concern because the interest rate has gone from 0 negative to 5% short term. And 5% leads to a total game change in many ways. And of course, it had led to the Silicon Valley Bank collapse and so on. And the big question with this big change of regime is, I make an analogy with what we could call dynamic fishing. Dynamite fishing. The bad behavior, you throw dynamite in the water, you kill all the fish, and then they come up. Usually, it's all small fish that come belly up, but the big whales take a lot of time to emerge from the depths, right? And usually, it's big banks or big institutions, big hedge funds like LCTM, right, in the crisis of 1998 with the Russian crisis, that default. And now we don't see big banks really defaulting or big institutions like Lehman Brothers or Benster and so on. Yeah, the Silicon Valley Bank was big, but relatively minor actor, in the big network of banks. Actually, this is different. Now the big fish or big whales are the Treasury and the Fed. They are selling. So let me explain. When you have a crisis like this, the institution that is in danger becomes price insensitive. So it means that they have to sell in order to balance their balance sheet and to get their margin at any price. Price insensitiveness means like this. Who is price insensitive now? The Fed and the Treasury of the US. They are selling on a tune of $220 billion a month, right? The Fed, in order to do its quantitative tightening, right? And the US Treasury, in order to fund its deficit, which are huge. And it's price insensitive because they have to do it whatever the price. And of course, as you know, it has led to a drawdown, a peak to valley drop in bond price, which is almost unheard of in historical times. And it's comparable to the greatest crashes on the stock market for a so-called risk-free or a low-risk investment vehicle. So this is another consequence of all this, extrapolating on your question, which is, in my view, the view that fixed income is low risk is dead. And investors have to completely reboot their thinking in terms of reassessing how to diversify.
Okay, so if you look at today, it sounds like we've gotten to that point where we're sort of going through a black hole, and it's almost like a new system, as you mentioned there before. Are you seeing any indicators that maybe suggest that we could be going towards a crisis, or is that not possible these days?
Okay, crises are always possible. And of course, we see so many converging, we could call exogenous stressors, the Ukraine-Russian war, the Chinese-US standoff. Now, of course, the Israel-Palestine war, and also the cascade with respect to Saudi, Iran, standoff, Israeli, the so-called normalization that was, developing that is going to be stopped. So many, and also the consequence on energy, the fact that probably because of Iran backing of Palestine, Hamas probably sanction is going to be increased significantly against Iran. Iran has scaled up its production of oil in the last few years because of a kind of like a kind of semi-blind eye from the US, right? So you are going to have 1 to 2 million barrel of oil per day of the market, maybe very soon, given the tightness of the oil production nowadays. So who is going to pay? Europe is going to suffer a lot because we are in a very bad position. Big consumers like China also, but Europe is very weak in this respect, and we have many other vulnerabilities. So when you say, is there another crisis? We are just living through crisis. Of course, we may not feel it too much. I mean, we feel it through inflation, obviously. We feel it through the news, the social media, and so on. Now, could it go to a level that would impact in your flesh, right, and really close to you? I mean, it impacts you with respect to your buying power. Okay, so to the opportunities also, if you are young, right? You're less young, whatever, when you look at job, in opportunities, in getting funding for your startup, all these are cascading, unfortunately. For example, venture capital is much tighter now, right? If you want to even in the US. So all this cascade. And so unfortunately, since 2008, and my diagnostic is only strengthened year after year with this succession of crisis and mismanagement, in my opinion, is that unfortunately, I'll be blunt, there is the impoverishment of 90% of the population. So this is the dismal consequence of the central bank policies and the treasury policies. So I repeat, 90, not 19, 90% of the population is getting poorer. This is the progressive euthanasia of the middle class. And there are signs about it. I mean, we feel everywhere. In France, we feel it everywhere. I mean, I live in Switzerland, so I'm, of course, it's a special paradise island of relative wealth and relatively good governance. It's the only working democracy really in the world, apart maybe from some Nordic countries. There's no president, there's no prime minister. There are 7 councillors. They are much modest. There's really power in the end of the people at the bottom and so on. But apart from that, I see really a big pain, more and more, unfortunately, for a vast majority of the population. It's like the proverbial frog, in the pan where you eat the water progressively, and we are all in this situation, unfortunately. Of course, it's much better for the top 1%, much better for the top 0.01%, and so on. So the wealth inequality has been growing to a level which is unheard of. The peak of inequality was in 1914, just a few months before the First World War, right? Then the 2 wars have been fantastic machines of destruction of infrastructure, wealth, and therefore level of the inequality. There have been scholars and academics who have indeed documented that the 2 great wars have been the main instruments for decreasing inequality, but in a bad way, by decreasing wealth of the haves. And then since 1980, inequality has grown a lot and is accelerating. And this is the consequence in my analysis of all the policies that we see, which are, you could say, yeah, but what can we do else, right? So which are done in order to kick the can down the road, right? To make as little ways as possible to keep the status quo. The problem is I make an analogy, suppose you see a person who is not in good shape, right? Is not eating healthy, is not drinking, is only drinking vodka, let's say, is not exercising, not healthy lifestyle. Okay, and there's inflammation, then chronic disease, and then there are more signs. And then, okay, you could do 2 things. You could say, okay, continue living as you are, maybe add some whiskey to your regimen, which, by the way, is exactly what the policymaker did. I remember an op-ed by no else than Larry Summers, Treasury Secretary of the US, President of Harvard University for a while, who wrote, I remember in June, I was shocked. I think it was in Financial Times in June, an op-ed in June 2012. He said, I quote, "The problem of the 2000 crisis and the subsequent pain comes from too much finance, too much debts, too much money. Paradoxically, the solution for this is, please, more debts, more money, more liquidity." It's as if you would say to a guy who has a hangover of vodka, say, okay, now we're going to give you whiskey or bourbon or whatever in order to treat you. And this is actually what is going on. We are doubling, tripling on the problems, and we are not attacking the issues at the core, which of course is politically suicide. I understand that, because the politicians have this conflict of interest of, pleasing the populace, the population, getting elected, and promising good times. If I come and say, well, you have been overfitting, you're obese, you are over drinking, now the pain, you are going to have to exercise, to do 100 push-ups every day, you have to have pain, right? You have to squeeze your belly, to eat less, to eat healthy, etc. It's not something you want to hear. And this is, unfortunately, the big problem of what we are now. So I'm not very optimistic about the future. And the only problem is that, we can, so there's an interesting parallel between the laws of finance and economics and the laws of physics, right? If everybody believes that quantum mechanics is not true and classical mechanics is true, nature doesn't care. Physics will continue to function according to quantum mechanics or whatever, best representation. If everybody believes that classical mechanics is the law of financial market, the financial market will behave according to classical mechanics for a while, for maybe 10 years, maybe 20 years. But because the financial market is coupled with the economy, and the economy is, of course, in the end, coupled with physics, with the law of nature, with production, supply chain, which are fundamentally the laws of nature, the correction that will occur, and this has been going on like this for centuries, has always been massive rupture, massive corrections. So this is a fear, right? That indeed we create our own virtual world, metaverse, right? We are in the spirit of creating our virtual worlds, disconnected from the laws of physics, the laws of supply demand, of really, the stock flow consistent processes in economics, which can work for a while. It's an illusion of the perpetual money machine, but then the laws of physics come back with a fury, with anger, and then it's very, very painful. So yeah, what do we prefer? To live in this illusionary world, and then there will be maybe World War III, maybe a very, very big problems, maybe in 10 years, or are we ready to bite the pill, right? Bite the solution, which will be painful, but spread over time. I fear the first one will be what will happen.
Yeah, so will that be fiscal responsibility from governments, the Fed keeping interest rates at a higher level so you can only invest in those positive,
exactly.
those, high ROI,
exactly.
Those will be the key things to do.
Exactly.
Perfect. And then I guess if we look at those indicators, are there any, you mentioned so many things, are they all flashing red, or are there any certain areas that you're seeing are flashing red at the moment?
No, I would say from an investment point of view, of course, avoid bonds, right? Avoid fixed income, especially from treasuries and from government bonds. But actually, there are some fixed income that could be interesting from a international diversification. Is China, for example, or emerging countries, because the Bundesbank, right? The central bank of Germany has been for many decades the last defense of a rigorous, monetary policy and interest rate policy. Of course, against the French in particular, right? Always at the dismal spirit of the French. But now it's no more the German, because they have endorsed, relatively profligacy and spending and so on, because they have to fund the energy transition, which is also, by the way, the energy transition is a huge drag with respect to impoverishment of the population, unfortunately. I think the new central bank that is more equivalent to the Bundesbank in the old days is the China central bank. So they are really remunerating, and they are much more. They are not subject to inflation. There's no inflation in China, or very little, and so on. So they are much more. So there is interesting. Of course, there is the country risk. Of course, that's another thing. So you have to be. But there is a number of plays like Vietnam, Indonesia, maybe Brazil, which are quite interesting from an internal investor point of view, that I would consider also for stock. But also invest in commodities, obviously. It's clear that this is something that is going to be on the scarcity level. So it's so there are, for investments or for investors, items that can give upside, that can give good return on the risk-adjusted basis. But we have to see much more broadly on an international level, and of course vastly diversified across different asset classes, but not the standard, equity, bond, Western developed markets, and so on. This is very worrisome.
Yeah, makes sense. So do you see the bond market potentially having a similar impact to what we saw in 2008 with the housing market?
Yeah, it's already done. Huh? He has already suffered the biggest drawdown almost in history, right? 50, 60%. Like it's a stock market crash. It's not a fixed income crash. So it's and when you see the trajectory is very parallel to some big crash in the stock market. So the question I think you have in mind is, can it continue? Can it continue? That's one scenario, because the problem is, the Federal Reserve and other central banks have only, very few instruments. It's like one instrument to solve everything, like the interest rate, right? And of course, they have added all this money, the quantitative easing and so on, but they are also tied with, because the problem is, how can you fight against inflation and save the world? That they saved the world in 2008 and then during COVID, right? By flushing the system with free money, right? So, and buying actually bonds, treasury bond, T-bond, so on, that nobody wanted anymore to buy, right? Similar for the European Central Bank, similar with the Japanese Central Bank, right? Which in proportion was even bigger doing that, and even manipulating the yield curve, right? And all this. So how can you flush a system with money and fight inflation at the same time? It's impossible. I mean, it's logically impossible. It's practically impossible. It's structurally, it's physically, whatever. It's impossible, right? You cannot do it. So another thing is, you have to understand why there was no inflation, so-called, before COVID, and why it emerged. That's another big story. I don't know how long you want me to speak, but we have to understand that the lack of inflation before and the new inflation that occurred, and there was a big misunderstanding. So during 2008, 9, 10, etc., 12, there was this big quantitative easing. The Federal Reserve and other central bank poured a lot of liquidity in the system, which, according to Friedman, mechanically should have led to inflation. And it was a very interesting paradox or conundrum among my colleagues in economists and so on. How is it possible to have what Friedman said, that inflation is always and only a monetary phenomenon? You have this monetary expansion of money to an extraordinary degree, right? And no inflation. So how to understand that? Well, first, yes, when the money goes to the purse of the household, you have inflation. The problem, so there are two aspects on this. The problem is that the money did not go to the pocket of the household, so they could not spend more. And inflation is the fact that, of course, you have not enough goods for too many consumers. So the money was staying at the level on banks, right, on the balance sheet of banks. So that's one reason. Another aspect is that when we say there was no inflation, it's not true. I'm living in Zurich. In 2007, an apartment was, let's say, 700,000. A few years later, it was 1.5 million. Okay, if I am the owner, I'm very happy. It's a capital gain. If I am a buyer, it's inflation. I have to pay twice as much in order to buy the same thing. So inflation the wrong concept is to think as a single number. Inflation is a multi-dimensional number. You have inflation for stock, inflation for real estate, inflation for food, inflation for energy. And of course, the policymakers bundled this into a single number, which is very misleading. So when we say there was inflation, it was actually a misnomer. There were a lot of inflation, indeed, because the money creation was directed to balance sheet of banks and to these assets, which indeed emerged as extremely inflationary. And the last dimension of this discussion of inflation was the globalization. Okay, so if wages are kept low due to global arbitrage, meaning Chinese can produce at low cost and Vietnamese and so on, as a consequence, the workers in the West cannot negotiate higher wage. And so if you don't have higher wage, you don't have higher consumer buying power. And therefore, you cannot buy more. Therefore, there is no inflation. Now, of course, COVID changed all this. And the Chinese-US trade war changed all this, right, with the deglobalization. And so inflation, which was misqualified or misdiagnosed by the Federal Reserve and also ECB and so on, as a transitory phenomenon, it was very clear for us more experts than the Fed that it was not a transitory phenomenon. It's a structural phenomenon coming from the destruction of this mechanism I just explained, that explain why there was low inflation, at least in the consumer basket. So this is a very important thing to keep. Just you see, when we start to think of all these issues, we cannot think linear, we cannot think monodimensional. Everything is entangled, and you have to really see how things cascade on each other and are entangled, and how the policymakers, of course, they are aware of this, but they have really blunt tools, which are monodimensional, unfortunately, and they cannot solve these problems. So much more structural solutions are required, but are costly politically, so they will not be done.
Yeah, unfortunately, it doesn't seem like it. So Didier, thank you so much for your time today. I really appreciate it. My last question is, what is one message you'd like people to take away from our conversation?
Yeah, so I would say, life is risk is life. So if for the young generation, I consider myself still young, right? So you are young as much as you take risk and you want to go to ventures and to open your mind and to learn constantly, it's difficult these days, but to take risk, right? And I told you privately before, I think I call it the cancer of modern society, at least in the West, is this hubris or this illusion that we can have a zero risk society. We saw it during the management of COVID, whatever it takes to save every life. Okay, the consequence is the cascade, an epidemic of all other illnesses in undiagnosed cancer, in depression of the young, in the cost for the lack of intellectual development of the young generation from kindergarten to school, to high school, to student and so on. So all these are unintended consequence of this zero risk policy, which is for me a nonsense. Life is risk is life. That's my last message. And I would like your editor to think about what is leading society, modern society, to hope to control all risks, while actually a booming, a striving society is one who proclaims failures as, like in Silicon Valley for a while, as actually a measure of success. You fail, and then you finally succeed. You fail, and you succeed. The problem is that there are so many headwinds, again, the young, the less young, the entrepreneurs, and so on. But we have to be courageous, and I hope that if enough of us keep this spirit, then whatever the policies, bottom up, we can change the world and get a better world. Because otherwise, other people, other countries will do it. And it will be, and I see that the 21st century will be Asia and not us, European, US, the West, as we have known it in the 19th century and 20th century. And so also it's a kind of existential point. You are in London, so your UK empire, at the top of the world for the most of the 19th century, of the second half of the 19th century, to, of course, our great pain as French. but US for the big part of the 20th century, no, the future will probably be Asia. And our position in the West will be depending on how much courage we have and how much we can go out of complacency and go out of this zero risk mistake. Well, I hope I gave him some clues. No answers really, but some clues to ask questions, right? That's the most important. Don't believe anything you hear in the media, all wrong, all manipulated. You need to question by yourself, to dig by yourself, and to try to understand the mechanism. Myself, I will finish that here. I've been educated as a quantum and theoretical physicist by 3 Nobel Prize in France, in Paris, at École Normale Supérieure d'Ulm. And I decided to go out of my comfort zone and to progressively learn. I became a relatively well-known professor of finance, professor of earthquakes, professor of many things. And why finance? Because finance is controlling the world. So you need to understand what is finance, because otherwise you are a sheep and you are going to be exploited. And this is a big project of mine in the future, is to develop teaching program to empower everyone. Otherwise, you are under control of the big financial institution and the big policymakers who exploit your naivety with respect to finance. So voila. So make the effort to learn, and maybe you can succeed for sure.
Yeah, perfect. There was some great messages. So thanks so much, Didier. I really appreciate it. If anyone wanted to find out more about your work and keep up to date with what you're doing, where would the best places for that be?
You can go on my website at ETH Zurich. So it's Emeritus website, but you can see a lot of resources there on many fields. And that's it. And also on the SSRN, social network, social science network, where all my papers go. And also on the Cornell Los Alamos website, where we put our archive preprint. So that, and then hopefully in the future, we're going to develop let's say a global website for Financial Crisis Observatory, where we are going to continue our diagnostic of the crisis in finance in various domains. But my transition from ETH to Shenzhen makes it a bit longer than I expect, but I hope we'll succeed eventually.
Yeah, perfect. Sounds great. So I'll put that in the description below, but thanks so much for your time.
Thank you.
Thank you so much for listening. And if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.